What's up, everyone? Welcome to Investing by the Numbers. I'm Simon Thompson, and today we're going to cover the best Canadian REITs for 2020. Now, most of these I own already. I've been buying. A couple of them are on my watch list. I'm just waiting for them to get to better prices. But we're going to deep dive on all of these, as I always like to do. I want to show you in detail exactly why I think these are a good investment. And so we'll dive in a moment. Plus, make sure you stay to the end because I'm going to show you a couple of REITs that I think you should avoid. These are very popular REITs. A lot of people really love them just because they're big mainly. So just make sure you tune in for that because I think it's going to be really valuable information and maybe it'll save you some money and some heartache in the future. All right, let's dive in. Okay, so before we begin, guys, I want to ask you to please hit that thumbs up button. It really means the world to me. I really appreciate your support, so thank you. And of course, subscribe and ringy ding dong those bells for updates. Okay, so let's talk about SmartCentres. Again, I'm going to link to my video that I did the other day on the 2 Canadian dividend stocks that I've been buying in May, and I really deep dive on SRU.UN in that video, so please check that out. And I'm just going to give you the number one reason why I think this is a good buy. So we can see here that they're paying out 9.8% dividend right now. I was buying this business at around $18.50 and $19 and even $19.50. So I put in about $1,000 into this business at this level here, and then also I was purchasing it back here at the similar level. So if you've followed my channel at all so far, you know that I am big on insider holdings. I like companies where the people who are making decisions about the business have a huge stake in the long-term success. And this business is the perfect example of that with Mitchell Goldhar, the gold man who started the company. He's a Canadian billionaire. He has a stake of $311 million worth right now in this business. And of course, that is normally worth about 30% more when it's not, economic turmoil happening. But I'm going to show you also he's been buying recently. We can see here that he bought on the 13th of May. He bought on March 19th. He bought on March 11th. And he also was buying back in February, and this is not a small amount either. He's in here buying $1 million or more at a time. In fact, in May here, he bought 1.5 million. So this is a guy who's making the decisions about his company and leading the way, and he's investing huge back into his business because he sees a lot of opportunity to buy his own shares in his own business at what he sees as a cheap valuation. So when you see something like this, this is kind of a follow the leader type of moment where he knows so much more about his company than we ever will, and his success and his track record really speaks for himself. So I like to invest with other people who are really putting their money where their mouth is. So let's go over CHP.UN, that's Choice Properties, and I'm going to move through these a little bit quicker. There's so much to cover, but I can't cram it all into just a few minutes, so I'm going to hit you with the highlights. And if you're a little bit lost, you can always download my guides, which I've linked below, so you can learn this framework that I have set up here, okay? This simple 8-point framework to quickly analyze a dividend stock. And I'll also link to some videos at the end of this video to help you better understand if you are feeling a little bit lost. Okay, starting with the payout ratio, CHP.UN has a great payout ratio, 38% on a cash flow basis. Now, the payout ratio is usually recorded as a measure of how much they're paying out of their net income, but I like to look at the free cash flow as well, and that's usually the more important measure. And when we add up the dividend that they pay, 74 cents, times the number of outstanding shares, 310 million rather, and then we divide that by the total free cash flow, we get 38%. So that's absolutely phenomenal. Most real estate investment trusts are paying out more like 80 to 90% of their free cash flow. So they are paying out a very conservative amount in their dividends. And the insider holdings are very strong. We can see here that the CFO has 6.2 million and the president has 16 million worth of common stock, and insider holdings are one of the most important things that we look at. And when we zoom in here, we can see their revenue line. This is this top highlighted line, and we can see they've had phenomenal revenue growth over the past 6 or 7 years. And when we look at this net income line, it's a little bit all over the place, but there's a really good reason for that, and I'll show you that in a minute. So when we see this type of thing, it's good to take a deeper look into the annual reports. And they have no economic moat, which just means they have no advantage as compared to any other players in the game, and that's pretty much standard for real estate investment trusts. Their financial health is good. Their debt is a little bit high, but that's very common with real estate investment trusts since they're investing into such huge projects, and it's primarily financed through debt. And when they are buying these projects, they're expecting very solid stable cash flows. So it has lower leverage than most other real estate investment trusts and is in pretty good financial shape. And we can see here that they have 15 billion in net assets, roughly speaking, and 11 billion in liabilities, or when we add the short-term liabilities together, 12 billion. So they have a surplus of 3 billion in assets. And when we take a look at the earnings per share growth, that's a little bit wonky too. And we can see here that the earnings per share are all over the place, and that is because of the weird net income number recently, as well as all of these new shares outstanding. And finally, when I look at the return on invested capital, it is about a 7 to 8% over the last 7 years, which is fair or good. I like to see it above 10% if possible. That would get the score of great. So taking a look at the 2019 annual report, they describe why they had such a significant net loss that year, and it was primarily due to the change in the fair value of the exchangeable units due to increases in the unit price. Now, when they were talking about the unit price, they're talking about the stock price. So I'll explain what exchangeable units are. So taking a look at the balance sheet, which is measured in thousands, we can see that these exchangeable units show up here and are worth $5.4 billion. And what those are is, instead of raising money through a normal debt, what they did is they issued debt in the form of these exchangeable units. So the debt holder has the option to either receive cash as a normal repayment for the debt that is owed, or they can change that debt into shares. So at a certain rate, they're allowed to essentially go, I don't want to get paid cash. I'm instead going to take shares. And so if that happens, new shares will be issued. And when new shares are issued, they are worth whatever the stock price is worth at that time. So from an accounting perspective, this debt has to be changed. This number has to be changed all the time because it needs to be accounted for properly. And when the stock price goes up, this debt on paper is actually worth more. Now, when they issue these shares, it doesn't actually cost them anything. It dilutes the existing shareholders. It puts negative pressure down on the stock price, but it costs them zero. So it's actually a great way for them to raise debt and not have to actually pay that money back in terms of cold hard cash. So I hope that makes sense, and that is why there have been so many new shares issued in the past few years, and it's also why there's been such a flat line in terms of the share price, because there's so much downward pressure based on the essential supply and demand of shares as these new shares are being issued. And so even though they've been growing like gangbusters, their share price hasn't really grown. But again, it means they get to pay off this debt without actually paying any cash. So I just wanted to show you their portfolio mix, and most of what they have are retail properties, and almost all of these retail properties are grocery stores. Okay, you can see the Real Canadian Superstore in the background here. So this is almost all grocery stores. Most of their income is coming from these grocery stores, which is just an extremely stable income source, right? Because grocery stores are going to continue to pay their rent whether COVID is happening or not. So final thing, I just want to show you their future plans. Basically, they're going to be focusing on expanding their portfolio to include residential as well as major mixed use development. So, grocery store plus offices or grocery store plus residential, this type of thing. And their residential is primarily going to be focused in Greater Toronto area, which I think is a great idea. Although with that said, I think there is likely a bubble in Toronto real estate as well as Vancouver real estate at the moment, which may slump in the near future if we go into a more serious recession or depression. But over the long term, I do think it is a strong play. So ultimately, I think for some of you more conservative investors, this is a great pickup. Next, let's discuss Automotive Properties Real Estate Trust. And these guys, you can see, have been slumping over the last couple of days. I bought a little bit here down at $6.70. And over the past few months, they've had an interesting story because their share price from the beginning of 2009 went from a low of $9 rocketing up to $12.76. So really gaining, I guess, quickly in my head, almost 40%, 35, 40%. And then, of course, COVID has been happening and things have really fallen off a cliff. And this is simply because, car sales will slow during a recession. That's pretty much a guarantee. And keep in mind that even though, yes, car sales are likely to slow, these dealerships are very likely to be able to pay their rent. So let's take a look at the APR.UN analysis sheet here. And guys, don't underestimate how powerful this is. You don't always need to do deep dive analysis of whether to know if you can invest in a business or not. As I've mentioned in one of my previous videos, just these top 4 can really give you so much knowledge about whether you should be investing or not. So the payout ratio is great. They're paying out about 65% of their cash flow, which is very strong for a real estate investment trust. The dividend history is good. It's a newer company. They've been around for 5 years or so, and they have been paying a consistent dividend of 80 cents. And we can see that here since 2016, they've been paying that dividend. And when we check the insider holdings, we can see that no one really has a huge position in this company, although Kapil Dilawri, I'm not sure if I'm getting his name right there, has $900,000 invested, and that's pretty strong. He's the chairman of the board. But when we come down to here in Simply Wall Street, we can look at the top shareholders, and we can see that 32.4% of the company is owned by this corporation in Alberta. And so when we look into that company that we just saw, what we come up with is that it is owned by the Dilawri Group, and the Dilawri Group is 3 brothers who have built the largest automotive group in Canada. So going back to our analysis, we can see the insider holdings are great because this company is mostly owned by these 3 brothers who have this huge automotive group, and then what they're doing is they've created this REIT as well, and they buy the properties where their automotive dealerships are located. So overall, the revenue has been growing strong and their profit is good. So we can take a look at their revenue, which has grown from $13 million in 2015 to $68 million in 2019. And their operating margin has stayed strong. So their net income is actually very good. But in this most recent year, it's minus $4 million. And the reason is because they have a similar situation where they've issued a ton of shares, essentially exchangeable units, just like we saw in CHP.UN. And the fair value of those had to be changed because the share price went up so drastically in 2019. So that's the reason for that. But overall, we can see that they've been growing and they have solid free cash flow and are able to pay their dividend. So when we go back quickly to our analysis here, we can say the revenue and profit is good, maybe even great. And the economic moat is poor, although I would argue that Morningstar says they don't have an economic moat, which is what I usually use. However, when I look at this and I think about it, what they do have is they have the Dilawri Group, which owns the dealerships that group acquires dealerships, upgrades them, makes them better, more profitable businesses, and then they give the first right of refusal to their own REIT, okay, to buy the property if the property is also available for sale, which oftentimes it is. So essentially, they have a really clean acquisition channel, and they are vertically integrated that way. And so they are never going to have to negotiate with the dealership on whether to pay rent or not, because they own the dealerships. And so also we can look at their financial health. I took a quick look at this. They're in good shape overall. The debt is fairly high, just like most REITs, but they do have lower leverage and $300 million in unencumbered assets. And finally, the earnings per share growth, not really worth looking at because of all the new shares that were issued and the one-off low net income in 2019. And the return on invested capital, I'd like to see that at 8 to 10% at least, but it's only at 5%, so that's a little bit poor. And I'll just quickly show you the financials from their annual report in 2019. So in 2019, their net operating income was $57 million, and in 2018, it was $40 million. So that's some really solid growth. And the main reason that they have this net income loss, again, is primarily due to the fair value adjustment of what they call their Class B LP units, which again is basically just the exchangeable units that we saw previously. I really like this business just because it's in a unique niche. They have a unique advantage by having both sides, and they're fully integrated. And the automotive industry is very fragmented. I'll show you that in a second. They discuss that. But also the dividend yield is almost 11% right now. You can get it. You can buy this stock most likely in this $6.78 range, which I did, and get an 11.5% dividend yield. They've come out and they've said they're going to be able to pay it. I'll show you that here in the research section of Webbroker, but they basically talk about how 94% of the REIT's base rent was collected in April and May 2020, and the rest is essentially going to be deferred. So they should be just fine in terms of their cash flows, and they've come out up here and I've said that they're going to be paying the distributions, and they don't think that they are going to have to adjust them at all. So finally, we're going to cover Allied Properties. I don't own any of them right now, but I've been considering picking them up. They hit a high of $60 recently. Now they're at around $40 and hit an all-time low of $31 during the March crash. Their dividend yield right now is 4.11% as of today. And Allied Properties basically owns hip office space, exposed brick and exposed beams and this kind of stuff. We can see here that their units are kind of trendy. And as I did my research, I really thought myself that they had a strong portfolio. These are the type of spaces that up and coming tech companies and these types of things want to be working at because they just feel like it's a really cool place. But I am a little bit worried about office space in general, just because of the potential changing nature of work due to COVID. I think a lot more businesses are going to have their people working from home, and we'll see how that plays out in terms of the renting of office space. So I am staying patient with Allied Properties. I want to see what their next quarter looks like, but right now their balance sheet has just been absolutely awesome. So it's about the cleanest, balance sheet. I mean, their financials here on Morningstar. It's just super clean. Their revenue has been growing consistently for the last 10 years. Their gross margins are pretty stable as well, although we had a dip recently. Not exactly sure why that is. You'd have to look a little bit deeper into why. Their net income has been growing this entire time consistently. Earnings per share have been growing consistently. Dividends have been growing consistently. The payout ratio is in a great spot at 34% of net income, which is very low. And if you do it on free cash flow, it's at a similar place. And the book value per share has been growing. Book value per share $42 right now. So it's just an overall very well-run company. And when I look at their leadership team, you see here we have our boy Michael Emery, and he is CEO. He's been doing it for 32 years, so I'm imagining it's since the inception of this company long ago. And he's got 43.5 million shares or 43.5 million worth of common stock right now. And when we scroll down to the board, we can also find Gerald Connor, who has 11.8 million worth of common stock. And remember, guys, that is the share value currently. Just a short while ago, that was worth about 30% more. So these guys are heavily invested in the business, and you know I love to see that. So all in all, Allied Properties, I think, is a great investment long term, but I do want to see how things play out. I could be wrong about that if the nature of work changes drastically from this virus episode that we're having. So a final couple of points. We haven't seen their Q1 report yet, and I'd like to see that before I would consider investing. And if the share price goes low enough after that, and I'm convinced that they might be all right, I'll probably buy some. We can see here that they've recently raised $300 million, and that is from their unsecured debentures, which is just debt at a rate of 3.13 per annum, which is very, very cheap. So that is great to see that they're still getting cheap debt. And finally, we can just look at their financial position, which is phenomenal. They have very low liabilities and have a huge number of unencumbered assets. So it's not surprised that they're able to borrow at a cheap rate. So I think this is just a very well-run, solid company with great insider holdings, and I'd like to own it, but I will be staying patient. All right, guys, I hope you found that valuable. If you did, please hit the thumbs up button. I really appreciate the support. It really means so much to me. I put a lot of work into this, and I hope that comes through. Also, drop me a comment below. Let me know if these picks sound good to you, or if you have a better idea. Let me know what is your favorite real estate investment trust. Okay, last thing before we go, and I've been saving this because I think it's important. The final thing I want to talk about is RioCan, REI.UN, and why I would not invest in it. I think it is a big no-no for me, okay, no bueno. And the reason is primarily because the insider holdings are so poor, all right? But there's also lots of other reasons, which I'll get into in a second here. But you know, the company was founded and is run by Edward Sonshine. He's 72. Credit to him. He's been built a really great business. But the guy only has 6.7 million in common stock in his own business. And meanwhile, he gets paid $6 million a year. Okay, so he has just over, in common share what he would actually earn in a single year from running this company. And so that's not a huge investment in your own business, and that doesn't give me a lot of confidence that you're confident about your business. Of course, you can go in and look at the insider holdings and see that he has a ton of stock options, okay? 3.3 million in stock options, which if triggered at whatever share price they're at, will turn into tens of millions of dollars for him. And this is kind of the exact opposite of what I like to see. When we think about SRU.UN, we've got Mitchell Goldhar, the gold man, and he is buying shares in his own company because he believes in it and he's investing in the long term. Meanwhile, back at RioCan, they are talking about what a great quarter they had. Mr. Sonshine is, sunshining it up in his report, not really talking about the truth of the matter, which is that, their earnings per share as compared to the quarter in the previous year have been cut in half. Okay, their revenue is down 12%, but meanwhile, he's only talking about the funds from operations and how that's been strong this quarter. Well, whoop-de-doo, because that doesn't last forever when your earnings and your revenues are dropping significantly. So I really don't like when CEOs aren't taking responsibility and addressing the issues head on, instead are trying to take a salesy approach. And when you go in and look at the numbers, again, the revenues haven't grown over this crazy bull market, okay, 10 years, they haven't grown their revenues at all, except for maybe in 2019, but other than that, it's really been flat. And then you also see a lot of share buybacks happening in the past few years to try to jack up the share price. Now, the share price hasn't been going up because the revenues aren't going up, and you can only do so much with share buybacks. But it's not something that I'm really interested in. The dividend rarely gets raised. So yes, it's at 10.5% as of the filming today. And I'm not saying it's a terrible investment. I think it could be good, but I think there are better options. And over the next 10 years, I'm a lot more comfortable with my money being invested with other people who are also thinking in 10-year timelines, not trying to get to their, option day payouts. So If you want to learn more about that, you can check out my video, The 4 Time-Tested Principles of Analyzing a Dividend Stock, where I talk a little bit more about insider holdings and why they're so important to successful dividend investing, or really investing of any kind in the stock market. And thanks for watching, guys. I appreciate it so much. Bye.